Welcome to the deep dive. It really feels like the global economic weather is just changing constantly these days, doesn't it?
It really does. One minute things look okay, the next, bam,
Yep.
a huge shift hits the markets, even the price of groceries.
Exactly. So today we're unpacking two really big interconnected stories based on the great sources you sent in.
Yeah, we're going to look at the future of asset management first.
Yeah.
We've got that Oliver Wyman report, 10 asset management trends for 2025. Really gives a peek into how the folks managing our money are thinking.
Mm-hmm.
And then we're diving into the U.S.-China trade situation, specifically China stopping Boeing deliveries. Got a bunch of sources for that: Pinnacle Gazette, Aviation Week, Lehman News, Economic Times, Times of India.
Right, a whole stack. So the mission today is to figure out how these big picture asset management shifts connect to, well, very real things like trade wars and what it means for regular people, for investors.
Let's do it. Lots to cover.
Okay, so let's start with that Oliver Wyman report. The first trend they flag is integration becomes integral. What's the core idea there?
Well, um, it's basically saying asset managers can't really operate in silos anymore. Separate teams for products, sales, advice, admin. It's just not working efficiently.
Right, so breaking down those walls between the people designing the funds, selling them, advising clients, even the back office stuff like risk.
Exactly. And the driver seems to be us, the clients. We're demanding, or at least expecting, a much smoother, more joined-up experience.
Makes sense.
Yeah, and to give a great example, the retirement market is massive, like $400 billion. To really serve people planning for retirement, you need everything together: the investments, the planning advice, maybe insurance, the tech platform. It needs to be holistic.
But interestingly, the report says not many firms have actually, nailed this yet.
Surprisingly few, yeah. The prediction is that's going to change. Companies will need to, connect their data, change how they reward teams, really reorganize around the client, not their own departments.
So for listeners, this could mean things get maybe simpler or more personalized down the line.
That's the hope. Okay, second trend, public and private melding.
Mm.
This one's really interesting too. It's about blurring the lines between, normal stocks and bonds you buy at an exchange and private stuff like private equity or private debt.
So mixing them up more, like putting listed stocks and unlisted company shares in the same pot?
Sort of, yeah.
Yeah.
Especially with credit products. The idea is if you combine them smartly, you can potentially get better returns for the risk you're taking, maybe better liquidity sometimes, and decent fees.
And this is actually happening. People are creating these blended products.
Oh, yeah. They mentioned these semi-liquid pooled vehicles, a bit of a mouthful, but they've grown like 19% a year since 2018. That's huge growth.
Wow.
And things like European long-term investment funds, LTIFs, they're part of this too. Technology is a big enabler, obviously. Makes it easier to customize and deliver these complex mixes. They're even building exchanges like secondary markets for some of this stuff.
But it can't be easy, right? Mixing public assets, which are priced every second, with private ones that are harder to value.
Definitely not simple. The report flags the challenges, structuring them, selling them, pricing them accurately. It probably means we'll see more partnerships, maybe even mergers, just to get the right expertise together.
Okay, what's next? Seed or secede? This sounds like it's about insurance companies.
Exactly. Insurers are sitting on a ton of assets through their investment arms, like $9 trillion.
Huh.
And they're trying to figure out the best way to, well, get value from that.
So they have to decide, either double down on the asset management side or maybe get rid of it.
Pretty much.
Yeah.
4 paths outlined. 1, become asset management-led insurers, basically using insurance policies to feed their investment strategies.
Yeah.
2, use their own money, their capital, to aggressively seed new funds and strategies.
Right.
3, create internal asset management utilities, just managing their own money, maybe for specific needs. Or 4, the big one, just sell or spit off the whole asset management business, monetize it.
That last one could really shake things up, couldn't it? Change who owns some big investment managers.
Absolutely. Big potential changes there. Now, shifting focus a bit, internationally, the report talks about managers rethinking their global footprints, going glocal.
Local. So global but local. What's the story?
Yeah, it's kind of surprising. Despite all the talk of globalization, it seems U.S. and European asset managers haven't really cracked managing more money for foreign clients. The share of assets they manage for clients outside their home base actually dropped a bit since 2018.
Really? From 23% down to 21%. That is surprising. Why?
Seems like a few things. It's hard to just export your products and have them work everywhere. Local investors often prefer local stuff, homegrown products, and local competitors are getting better. Plus, the cost of distributing internationally has gone up, but the assets haven't always followed.
So global means be more selective, pick your battles internationally.
Exactly. Instead of trying to be everywhere, they'll likely focus their money and effort on a few key countries where they think they can build a really strong local feeling operation. Maybe buy local firms, tailor products more.
Less spreading themselves thin. Makes sense. Okay, next up, quant strikes back. Sounds dramatic. Systematic investing is making a comeback.
Yeah, it seems so. You've got all this pressure on traditional active managers, right? Performance hasn't always been stellar. Fees are going down. Costs are going up.
Perfect storm almost.
Kind of. And that makes these systematic quantitative strategies look more attractive. They use data, algorithms, quantitative tools to build portfolios efficiently, often at a lower cost.
Is this about robots taking over from human fund managers?
Not entirely replacing them, no.
No.
But the report suggests even traditional managers will use more quant tools. They reckon integrating these tools could cut investment production costs by maybe up to 30%. That's a big deal.
30%? Wow. That could mean lower fees for investors eventually, maybe.
Potentially, yes. Or just better margins for the firms.
Okay.
Okay, next is direct dial for dollars. This is about how they sell funds, the distribution. So the trend is managers wanting to connect directly with the end investor, you and me, rather than just going through financial advisors or platforms all the time.
Why the shift? Haven't intermediaries always been key?
They have, for scale. But the downside is the asset manager often doesn't really know the end client very well. They get limited data, less understanding of what people actually need or want.
Ah, okay. So going direct gives them better intel.
Exactly. Better data, deeper understanding, allows them to build better products, maybe offer advice directly. Plus, if you have a direct relationship, maybe clients stick around longer, even when markets get choppy.
And they're less worried about upsetting the advisors now.
Seems like it. The report kind of suggests those channel conflict fears are fading a bit. Lots of people manage some money themselves anyway or use multiple advisors. Direct sales are already like 15% globally and growing.
Interesting dynamic. Okay, the last big trend from Oliver Wyman. Exiting the exchange. Sounds ominous. Asset managers leaving the stock market.
It does sound dramatic. But yeah, for some traditional asset managers, especially those needing a major overhaul, new products, new tech, new talent being a public company, with the quarterly reporting pressure and market scrutiny, it might not be the best fit.
Because they need long-term focus, not short-term results.
Precisely. They need patient capital to reinvest and transform. And it's tough when you're constantly compared to, say, the alternative asset managers.
The private equity guys and hedge funds.
Yeah. The report points out that alternative managers now make up 70% of the sector's total market cap. They've grown six-fold since 2018.
70%? Wow! Six-fold. That's astonishing.
It is. Meanwhile, many traditional managers, especially the smaller ones, their stock prices haven't really gone anywhere, so investors are getting wary.
So the prediction is some might just go private.
Yeah, we might see more managers leaving the public markets, maybe through mergers with firms with patient capital like big financial groups, or even management buyouts. It could really change the ownership landscape.
Okay, that's a lot to digest on the asset management side. Really interesting shifts happening, but it definitely feels like this need for change, for maybe more resilient strategies, connects to the other big topic today.
The U.S.-China trade tensions. Absolutely.
Let's dive into that. The huge news hitting all the sources was China telling its airlines, stop taking Boeing deliveries, effective Tuesday, April 15th, 2025.
Yeah, and it's pretty clearly linked to the trade fight. It's retaliation for those higher U.S. tariffs on Chinese goods tariffs hitting up to, 145% on some things?
Ouch. And the market noticed immediately, right?
Right.
Boeing's stock dropped.
Took a hit, yeah.
Yeah.
Over 2% down on the news. And it's not just finished planes sitting on the tarmac.
No.
No, the instructions apparently go further. Chinese airlines were also told to halt buying aircraft parts, equipment, spares from U.S. companies, too. It's pretty broad.
So how many planes are stuck right now?
About 10 Boeing 737 MAX jets were apparently ready for delivery. Now they're just caught in the middle.
Is there any wiggle room? Any chance those get delivered?
Maybe. There's a small possibility if all the paperwork was done before the tariffs kicked in on April 12th. It might be case by case. But overall, it's a major disruption for Boeing.
And this is all part of that tit-for-tat escalation, isn't it? U.S. tariffs on China, China tariffs on the U.S.
Exactly. We're seeing U.S. tariffs up to 145%, China hitting back with up to 125%. It just makes everything more expensive for everyone involved.
And the Economic Times specifically mentioned this makes U.S. planes and parts more than twice as expensive for Chinese airlines, basically unaffordable with those tariffs.
Yeah, it prices them right out of the market. And we're hearing China's even looking at ways to help its own airlines that are already leasing Boeings because their costs have shot up too.
Wow, so it hits existing operations, not just new sales.
Right. The ripple effects are significant. And for Boeing, losing access even temporarily to the Chinese market, that's a huge blow.
Yeah, China's projected to be like a fifth of all global aircraft demand in the next few decades.
Well,
20%.
it's massive. And remember, back in 2018, almost a quarter of Boeing's deliveries went to China.
Though, as the Times of India noted, they haven't had major new orders from China recently anyway, partly because of trade tensions, but also Boeing's own issues.
True. The 737 MAX grounding back in 2019, the quality concerns more recently in 2024, that hasn't helped.
And meanwhile, Airbus, the European competitor, seems to be benefiting.
Looks that way. China's been buying more from Airbus, so the trade war is directly shifting market share in aerospace.
Okay, so aerospace is hit hard, but these tensions, they're having wider effects too, right? Like on gold.
Oh, definitely. This kind of uncertainty, this geopolitical tension, it tends to drive investors towards safe havens. And gold is the classic safe haven.
We've seen those record prices. Bullion Vault reported a new all-time high, $300 and $245 an ounce. And prices in China hitting records too.
Yeah, and what's really telling is the trading volume in China, the Shanghai Gold Exchange, the futures exchange activity just surged in April as these tensions ramped up.
Why the rush in China specifically? Is it just the tariffs?
It seems to be a combination. The tariff uncertainty, sure, but also the Chinese yuan has been weakening, which makes gold, priced in dollars, look attractive. Plus, just regular retail investors buying gold too.
And analysts think this could continue. Gold prices staying high or going higher.
Some do, yeah. Bullion Vault quoted analysts saying strong haven demand could keep pushing prices up through the rest of this year, maybe into 2025, as long as this uncertainty hangs around.
So beyond planes and gold, the whole trade situation just casts a big shadow, doesn't it? Lots of economic uncertainty.
Absolutely. Even with some temporary tariff pauses on things like electronics, the overall policy direction from the Trump administration is still pretty unclear, and that makes businesses nervous.
And there are worries about the U.S. economy slowing down because of all this, maybe forcing the Fed to cut interest rates.
That's definitely part of the conversation. And you've still got potential future tariffs hanging over key sectors like semiconductors, pharmaceuticals. It just keeps the uncertainty level high.
Okay, so if we bring these two big threads back together, the asset management world is changing, adapting partly because of this kind of global uncertainty, right?
It really seems that way. And it's fascinating to see how some big players are responding right now. There's that recent announcement, a big alliance.
Right. Wellington Management, Vanguard, and Blackstone. I mean, that's a lineup of heavy hitters.
It really is. And look at what they're aiming to do. Develop simplified multi-asset solutions, integrating public markets, private markets, active strategies, index strategies, all together.
That sounds exactly like those Oliver Wyman trends integration, public-private melding.
It maps directly onto them.
Yeah.
And the goal seems to be broadening access. Taking these sophisticated portfolio approaches, which used to be just for giant institutions, and making them available to, well, more individual investors.
Trying to build more resilient portfolios with private assets to chase better returns in this, well, choppy environment.
Seems to be the idea. And each firm brings something different, right? Wellington's got the active management skill, Vanguard brings low-cost index and active, and Blackstone is the leader in private markets. Plus, they've been focused on reaching individuals lately.
So you see the trade wars creating uncertainty, pushing gold up, and you see asset managers teaming up to offer more diversified, maybe more robust options for regular investors. It all feels connected.
Very connected. The need for diversification, mixing public and private, trying to reach more investors, it all seems amplified by this complex, uncertain global picture, perfectly illustrated by the U.S.-China situation.
So pulling it all together from our deep dive today, the asset management industry is definitely transforming, partly because it has to navigate this unpredictable world. The U.S.-China trade war is a huge driver of that uncertainty, hitting specific sectors like aerospace, boosting things like gold, and just generally making investors look for safer, more diversified options.
And the way big managers are responding, like that Wellington Vanguard Blackstone link-up, shows a real push towards making those more diversified, potentially more resilient strategies accessible to more people.
Which leaves us with a pretty big question for everyone listening, doesn't it? Given all these shifts in asset management in the global economy, how should we as individual investors maybe rethink how we build our portfolios? How do we manage risk now?
Yeah, what role do things like alternative assets or global diversification really play for us in the coming years? It's definitely something to mull over.
Absolutely. Plenty of food for thought there. Thanks for joining us for this deep dive. We definitely encourage you to keep thinking about these complex trends and how they might shape your own financial path.